Welcome to the Deep Dive. So today, we're making a bit of a fundamental shift.
Pretty big one.
Yeah. We've focused a lot recently on, managing the immediate, the tactical stuff like tax liabilities, protection mechanisms.
All the necessity.
Exactly. Now we're moving into the strategic realm, how wealth is actually grown and protected and structured over decades. This is really the core of investment planning.
And our mission today really is to give you that solid foundation. We're trying to go past the basic definitions and get into the principles that really govern successful investment management.
Right.
And I think more importantly, we're defining the specific high-value role of a professional advisor here. It's not just selecting products. It's about guidance through complexity and, I think crucially, through behavioral instability.
I love that focus. Because if we strip away all the jargon, the main insight is still that investing is not just a numbers game.
No, not at all.
It's this conscious process of, creating a future that the client actually values. It's the mechanism for funding independence, education, legacy.
And once you realize that, it changes everything about how advice is delivered. The advisor becomes more of an architect, not a salesperson.
An architect, I like
Yeah, because they have to manage these inherent conflicts that just pop up in every single financial plan. They're balancing, ambitious growth versus the client's tolerance for risk.
And short-term versus long-term.
Exactly. Reconciling short-term liquidity needs with those long-term time horizons. And critically, they're providing discipline when the market gets, unpredictable.
Okay, so let's start at the very beginning then. Before any money moves, you have to understand the why. What are those diverse, specific goals that drive someone to invest in the first place?
Well, they tend to fall into about 5 clear buckets. First, the obvious one is just to actively grow wealth, capital appreciation over time.
Sure.
Second, and this one is often overlooked, is the defensive goal, protecting the value of the capital you already have, specifically investing against that silent, persistent killer, inflation.
That's such a critical distinction. I mean, investing defensively is just as important as investing aggressively.
Absolutely. The third goal is generating income, creating a reliable stream of cash flow, which is, vital for retirees. Fourth, clients often invest for specific milestones. Maybe it's funding a business, a child's university education, or, of course, securing a comfortable retirement.
And the fifth?
And the fifth is that generational goal, making sure wealth transfer is efficient, providing for children or grandchildren.
So the investments themselves, the shares, bonds, property, they're just the tools you use to get to those life outcomes.
Precisely. The capital structure is secondary to the client's life plan, and that makes the initial phase the most vital part of the whole process.
The fact find.
All investment planning has to begin with that comprehensive fact find. If you don't have this really deep understanding of the client's finances and their psychology, any recommendation you make is basically guesswork.
It's like a true financial diagnosis. So beyond the basics like income and debt, what are the key data points an advisor needs to capture to make a plan that's actually robust?
Well, the quantitative data is pretty standard. You need detailed income and expenditure, debt levels, existing savings, pension arrangements, all of that.
Right.
But the qualitative element, that's what separates good advice from great advice. The fact find has to crystallize the client's main objective into one of 3 categories. Are they focused on, say, accumulating wealth for the long term?
Okay.
Or are they prioritizing generating income right now? Or is their number one concern just to preserve capital above all else?
And why is drilling down into those 3 so crucial?
Because they determine the entire approach, and they're often in conflict with each other.
Ah, okay.
If a client wants to accumulate wealth quickly, they have to accept higher volatility. If they insist on preserving capital, well, they have to accept lower potential returns. An advisor's job is to identify that dominant objective, or sometimes the necessary trade-off if the client wants to do all 3 at once.
Which probably means the strategy won't be great at any of them.
Exactly. The fact find helps the client confront that reality right from the start.
That transition to confronting reality, that brings us right to the markets themselves. We have to talk about risk. It's the, unavoidable part of any investment strategy.
It is the foundational truth. All investments carry risk, and the advisor's job isn't to eliminate it, which is impossible.
Right.
It's to manage it and mitigate its impact. The key shift in perspective is getting clients to see risk as something to be systematically understood, not something to be feared.
Let's dig into that idea of unavoidable risk. You mentioned that even the quote-unquote safest option, just holding cash, involves risk.
Yeah.
Tell us more about that.
It's a really simple but profound truth. If the inflation rate is, let's say, 3%, and your cash savings account is giving you 0.5%.
Which is generous these days.
Yeah, very generous. You're losing 2.5% of your purchasing power every single year. In a decade, your money buys significantly less, even though the number in your account looks the same.
That's the risk of doing nothing. A guaranteed loss over time.
It is. And then you move into the more traditional investment risks.
So what are the key categories there that an advisor helps a client navigate?
Well, you have market risk, the systemic risk that the entire market moves against you, like in a major downturn. Then there's specific risk, the chance that a single company or sector does poorly.
Right.
And liquidity risk is a big one for certain assets, particularly property. That's the risk that you can't actually sell the asset and get your cash quickly without taking a big loss.
So a house might hold its value on paper, but if you need that money for an emergency next month, the fact that you can't sell it easily becomes a very real financial risk.
Exactly right. And the strategy for dealing with all these different risks, well, that brings us directly to the two main pillars that support every long-term investment plan. Okay, so pillar number one, the big one. The defense against the unpredictable, diversification. We all hear the phrase, don't put all your eggs in one basket, but let's get a bit more technical. What's the actual mechanism that makes it work so well? The mechanism is correlation, or rather a lack of correlation. True diversification isn't just owning 3 different tech stocks.
Yeah.
It's owning assets whose prices don't move perfectly in sync with each other. So if asset A tends to go up when asset B goes down, they have a low or negative correlation. By combining them, you smooth out the whole return profile of the portfolio.
So you're not just spreading risk across sectors, but across asset classes, stocks, bonds, property, maybe alternatives, and also across geographies. So if the UK economy hits a rough patch, hopefully your exposure to, say, US and Asian markets might buffer that impact.
Precisely. The goal is that when one part of your portfolio is struggling, maybe because rising interest rates are hurting your bonds, another part, like certain commodities or specific equity sectors, might be doing better.
Mm-hmm.
The key caveat, of course, is that while diversification can't guarantee a profit, it fundamentally makes the outcomes more predictable and manageable. It reduces those gut-wrenching spikes in volatility that lead people to panic. That's robust risk management. So let's move to the second pillar, which is often the investor's secret weapon, the power of the time horizon. Why does the length of time just completely redefine the strategy? Time is the great neutralizer of volatility. It really is. A longer time horizon gives a client the luxury of being able to tolerate short-term losses because they have years or even decades to recover.
And compounding works its magic.
It allows compounding to work its magic, and it allows those temporary dips to be seen as buying opportunities, not calamities.
Okay, let's use our 2 examples. A client in their late 20s saving for retirement in 40 years. What does that time horizon let them do?
It permits them to take significant risk. They can allocate a much higher percentage of their portfolio to growth assets like equities, which are volatile, yes, but they offer the highest long-term returns. They can afford to ride out multiple major market cycles. Short-term volatility just doesn't matter as much to them.
And now, let's contrast that with the client who is 5 years away from retirement.
The strategy completely reverses. Their time horizon is short, so volatility becomes incredibly dangerous. A big market drop just before retirement could devastate their plans with no time to recover.
So their strategy shifts. It has to. It shifts towards capital preservation, generating reliable income. That means a much higher allocation to lower risk, lower growth assets like high-quality bonds or cash flow funds. The insight here is just undeniable. Patience isn't just a virtue. It's a mathematical advantage. And patience is absolutely required when you see those red numbers flashing on the news. This brings us perfectly to what I think is where a modern financial advisor provides their greatest value, managing the emotional roller coaster.
It's the human element, and it's probably the biggest single threat to any scientifically sound plan. Markets are moved by data, but clients are moved by fear and greed.
FOMO, fear of missing out.
Exactly. When markets have a dramatic surge, clients get that FOMO and they want to abandon the plan, take on way too much risk, and chase returns that are probably unsustainable.
And then the inevitable happens, a major correction or a crash. What's the behavioral consequence then?
Panic. Pure fear takes over, and the client wants to sell everything, usually at the absolute worst possible time, crystallizing their losses.
Selling low.
The advisor has to recognize that their main job in those moments is not portfolio management. It's being an emotional circuit breaker. Their value comes from enforcing discipline and providing that historical perspective that, downturns are normal, they're temporary.
So can you give us a tangible example? A client calls up in a panic. What does the advisor actually do?
They'll call up wanting to liquidate everything. The advisor's job is to gently pivot them back to that original fact find. They ask, have your goals changed? Are you suddenly retiring next week?
If not,
If not, then the plan we built accounted for this kind of volatility. They provide the perspective that the market noise is separate from their long-term focused goal. Staying invested, sticking to the plan is the hardest thing for a person to do, but it is the most critical factor for success.
and that stability is underpinned by understanding the bigger picture, the broader economic context. We know performance isn't static. It's shaped by all these external forces.
Absolutely. Performance is influenced by the macro environment. You've got interest rate decisions from central banks, inflation rates, government policy, corporate earnings, global geopolitics. All these forces dictate which assets thrive and which struggle. But here's a key point that the sources really stress. Advisors don't need to be economists. They don't have to predict the future. No, and frankly, trying to is often counterproductive. Their role is much simpler and more effective. It's to help clients understand that a well-diversified strategy is explicatively built to account for the uncertainty of these forces.
So you build for resilience, not for protection.
That's it, exactly. You don't know what will happen, but you make sure the portfolio can withstand several different potential outcomes. Resilience requires clarity, and that brings us to the final element: communication and trust. The jargon barrier in finance is just immense. It's a huge hurdle. If clients don't understand what they own and why they own it, they can't stick with the plan when things get tough. A great advisor just translates that complexity into simple, confident explanations.
So what are the 3 core things that have to be communicated for a client to feel that real confidence?
First, the client has to understand the rationale, why the specific strategy aligns with their stated risk tolerance and their unique financial personality.
Okay, the why.
Second, they need to understand the mechanism, how their portfolio is actually built, what's in it, and what's a realistic range of fluctuation they should expect. If they know a 15% drop is normal, they won't panic when it happens.
And the third.
The third is the purpose. Every single decision, every rebalance, every strategic shift has to be clearly tied back to how it supports their ultimate goals: retirement, income, legacy. If the client understands the why, they stay disciplined through the downturns.
And when that complexity is translated into a simple, coherent story, trust is built, and the value of professional guidance becomes undeniable. We've really laid the groundwork today: goals, risk, diversification, time, behavior.
And these fundamentals, they're the critical starting point. They pave the road for everything else. For exploring the specific tools, different types of bonds, equities, collective investments, understanding ESG factors, and how all those pieces fit together into a suitable and compliant plan.
But it all rests on this foundation.
Without the discipline we talked about today, even the best portfolio structure in the world is doomed to fail under emotional pressure.
So as we wrap up, let's just reiterate that core insight. Investments are not abstract figures on a screen. They are literally the embodied hopes of a client for their future. The advisor's real success is making sure those hopes are pursued with confidence, discipline, and clarity.
And that leaves us with one final thought for you to consider. We've established that patience is an investor's greatest advantage, and emotional reactive decisions are the greatest threat. So if the goal is long-term stability and discipline, what is the single greatest daily habit, or maybe the deliberate absence of a habit, that provides the most insulation against the constant short-term noise of the market? Is it avoiding the financial news? Checking your portfolio less often? The answer really lies in how you manage your own reaction to high-stakes information. Think about what truly reinforces your long-term focus.